And welcome to the Loveland Report and the Lone Ranger Show. We are on every Saturday giving you your real estate and mortgage news. I am Cleve Loveland, broker owner of Loveland Properties. My family's been selling real estate in Central Florida for just about 45 years. And chances are on your street, one of those rooftops, I've helped sell it, I've helped buy it, or I've managed it as an investment property. And I've got the man who's printed more paper, just like the government.
We're printing
more
paper
mortgage
like
paper.
crazy,
Mortgage
baby.
paper. We print mortgage paper.
Mortgage paper.
Actually, it's all online. We're not killing trees. It's all online, right?
It's all, yeah.
Go
Nowadays it is,
you go to a portal.
It's funny you say that, Cleve, because, I still like that personal client interaction, right?
Yep.
But the younger generation, they're like, no, I'll just do it online.
Yeah.
I'm like, I'll meet with you. You want to meet?
Yeah.
And, I find that the personal meetings, you still develop a deeper relationship, trust factor with people when you can meet with them.
Well, it's true. Somebody's looking at a computer screen and they don't understand something, and then they go Google it. What'd they get?
Right.
They got 100 wrong answers instead of asking an expert like us.
That's right.
So, but you've got big news. I mean, you talk all the last couple of months. You've been talking about how 80% of the people out there should refinance.
That's right.
The rates were in the twos 6 months ago. They're not there anymore.
Rates were in the twos a month and a half ago, but now
they're gone.
Now they're up. So as you had mentioned, I have been preaching to all of my loyal listeners out there on this show and my Sunday show about do it now. Rates are going to go up. But you know what? I think a lot of folks out there just believe that might be some type of a sales presentation, right? It's just encouragement to react, but it isn't. It's not at all. That's not at all what it was.
Yeah.
Because if we look back, January was our best rates.
Yep.
Then they started to creep up a little bit, but they were still incredibly attractive.
Yeah.
Now
they're still good.
They're still great.
Yeah.
Okay. They're still great.
Unbelievable.
However, let me just share this with you. In the last 2 weeks, we have lost 160 basis points on the bond market. Now, how does that equate to an individual? How does that equate to anyone when they go, well, I don't understand how the bonds affect me in a mortgage. Here's how they affect you. For every 100 basis points that the bond market deteriorates, it costs you 1 point. So 100 basis points equals 1 point on your mortgage.
And a point is like 1/8%?
No, a point would be to the discount, to the cost.
Okay.
So what happens is the easiest way to really put this in perspective, if a loan was at, let's just say 2.99 2 weeks ago and 0 points. Today you would be at 2.99 and 1.6 points. So people say, oh, well, wait a minute, I don't want to pay 1.6 points. So what happens is the lender buys up the discount. So in order to be at no points, you might be at 3 1/4 or 3 3/8 right now, right?
Yep.
So lenders adjust the rate. So the cost, we can adjust rates up or down.
Just like absorbing closing costs.
Of course,
a little bit. Yeah.
The companies that say, oh, I'll pay all your closing costs.
Their rate's higher.
They're not paying the closing costs for you. You guys are smarter than that. All they do is bump your rate up to get what's called a yield spread premium that Fannie Mae, Freddie Mac, HUD pays us to sell them a loan at a higher interest rate, and then we use that money to pay your closing costs. Now, I'm not a big believer in lender-paid closing costs. Not because I have to pay them, because I don't pay them.
Yeah.
The client pays them.
Yeah.
They just pay it in a higher rate. Same with any other lender out there that promotes that program. I don't like it because you're better off to pay your own closing costs and get a lower rate, because your break-even period is probably about 3 years. By paying your own closing costs, you're going to be in the house for 7 to 10.
Yeah.
So why would you go and the only time I go no closing costs, if you're not going to keep the house for 24 months, for sure.
Yeah.
Don't keep it for 24 months, then no closing costs.
Well, go ahead.
No, well, I was just going to say, I thought that was an important question. It's still not too late. There was 81% of the people that should have refinanced that haven't refinanced. It's probably dropped.
So a rate probably above 4, they should call you, because they could go to a 15 and have close to the same payment.
Absolutely. I'm doing a lot of 15-year conversions right now.
That's the smartest thing out there.
It's the smartest thing, but people have a little tough time grasping the payment difference, because you got to remember you're cutting 50% of the term off, which cuts off about 80% of the interest.
Yeah.
It's a massive amount of interest savings. Yep. But what I like doing for clients, Cleve, and I know this is why you like sending your clients to me, I like the debt consolidation. I'll give you an idea. Got a guy I'm debt consolidating right now. Refinancing his mortgage, keeping it at 30-year, paying off about $85,000 in cars and other debt. His CPA, his financial planner said, oh, you don't want to pay off a depreciating asset. Wrong, because I could keep him paying the same payment he's paying now between
monthly,
his mortgage,
Yep.
his mortgage, his car, and his credit cards. And listen to this. No credit cards, no car loan, no mortgage, 8 years. Completely debt-free.
But this is a thing. Don't go get another car payment. Don't go get another credit card.
Because now you should be able to sock money away and pay cash for it.
Yep.
And listen, a lot of you folks can't pay cash for it because you're buying $45,000, $50,000 cars, and if you can't pay cash for it, I personally, once I amassed enough money, I've never financed another vehicle again.
Yep.
And some financial people say that's not right. I just prefer debt-free. I'm in the business of getting people in debt, but I'm in the business of helping them get out of debt.
That's right. So we've got really good interest rates. Here's one thing. So if you got anything north of 4%, call Bruce. What's the number?
407-250-9144. That's 407-250-9144 or webringyouhome.com.
I want to talk some numbers right now. Our market it was blazing hot beginning of the year. It's still on fire, not quite as hot. So I get 5 to 10 offers on a house instead of 20 to 30. So it is people, because prices were rising, and the one cure for high prices is high prices. Right. It will slow people down, and people think twice. And they've got so much information at their hands from their realtor, and they will pay you right. They will pay you a good price for the right home in the perfect condition for that family.
Right.
But usually that's meaning going 1 or 2 or 3% above list price, not 50, 60 grand. Now I just sold one. Somebody went 50 grand over list. I was surprised, but that was like 8 or 9% above list. But here's the important part. Inventory is holding steady. This inventory is what keeps the multiple offers coming in. Inventory is only about 3,500 homes, and it's been that level for about 6 months. A year, let's say 18, 19 months ago, January, February of 2020, you know where we were?
How many?
7,000. So still a seller's market.
Still a seller's market, but double the amount of inventory.
But what I got back then, I would get multiple offers on the starter home. And back then, the starter home, the median price was around
$220.
No. 2 years ago. No, you're thinking 10 years ago.
$250.
No, it was like $290. Now it's $360.
Yes.
So literally that starter home has gone up so far. Now, it can't climb too much because then you open up people's options and they go to different areas of town to get more affordable. And we've got some really good listings. I've got some examples of that, a good starter home. And then you've got some examples of some new home products we're going to talk about at the bottom of the hour.
I can't wait to tell you guys about, too.
But the inventory is holding steady, and it's just not like in the bubble when things were crazy and people were paying 70, 80 grand over list price and nobody checked the loans. Then we only had like 2,000. We had 1,500, 2,000 listings. Yeah. So it's a steady burn on this market. And I'm hearing from realtors all around the country talking about how they're slowing down also. They used to get 20 offers. Now they're getting 5. Now, that's still a great market. Inventory is still tight. Builders can't keep up with demand. I am seeing a lot more emails from builders inviting us realtors out to see their new product coming.
Isn't it amazing how
they're going to love us again. They haven't needed us for the last 18 months. They're going to need us again, and they're starting to cater to us. And the best way you get realtors out is if you want to have realtors at your house.
Feed them.
Free lunch. So the trouble is, if you ask them how many sold 10 homes that month, no one would raise their hand unless I was there. But it's just
that is a true fact.
This market is doing well and should continue at this steady pace. Because I've had listings go on the market and not get multiple offers. And then we cleaned them up. We adjusted the market position. I got multiple offers the next 2 weeks. Right. So it happens. So, and then, at 600,000, I don't get as many offers as I do at 350. So,
well, of course not. You don't have as many people that are going to qualify for a $600,000 house. But, it's interesting because I look at other markets, and you and I both are involved in a big coaching organization, and we get to communicate and share ideas and thoughts and market situations with other realtors and lenders throughout the country. And when I look at other parts of the country, maybe Chicago, some parts of Atlanta, definitely California, San Antonio, Colorado, we see way higher prices than we're seeing in Florida. right?
Yeah.
Much higher.
Oh, yeah.
Right? So we now have the new Fannie Mae limits that